Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that's got a little bit of everything: love, money, and a whole lot of data. We're decoding Grindr's latest quarterly report. This isn't just about numbers, this is about how the world's most popular gay dating app is performing, what challenges it's facing, and what it's planning next. From user growth to revenue streams, we'll break it all down. But before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed, and we also have a Discord community linked in the description below where you can chat with other investors and analysts. Let's kick things off by peeking at their balance sheet. The most interesting number here is definitely which jumped from around $59 million to over $255 million in the bank. This is mainly because of the warrant liability and money related to this, which we will talk about later on. Accounts receivable, which is the money owed to Grindr but not yet paid, increased slightly to $53.20. Another interesting metric is intangible assets, which is around $67 million. This includes things like brand recognition and patents, things that aren't physical but still valuable. Alright, let's check out the income statement to see how the company performed over the last 3 months. The most important number is which was $93.9 million, compared to $75.3 million last year. That's a sizable jump, indicating a solid growth. It's important to remember the costs needed to reach that revenue. For example, selling and administrative expenses were around $30 million. While this is high, keep in mind this includes salaries, marketing, and general expenses that are needed to run a business. The bottom line is they earned $27 million. That's a big turnaround compared to a loss of $9.4 million from the same period last year. Cash flow is super important. Was about $23 million, so this means Grindr makes decent money from its main business operations. But not all the news is good, as they had to pay $131 million in repurchases of common stock, putting a dent in financing activities. This is where things get a bit technical. Warrants are like options, giving the holder the right to buy stock at a certain price. Grindr decided to redeem these, meaning they would buy them back from the warrant holders. It resulted in a lot of warrants being exercised, resulting in a lot of cash for the company. Now, digging into some of the details, let's check out the other current assets. About $77,000 in cloud computing arrangements implementation costs. Not a huge number, but it shows they're investing in their tech infrastructure. Also, it's good to see is the other side with accrued expenses. So includes $9 million to repurchase stock. This is normal for a large company. Debt is something all companies have. For Grindr, they have a credit agreement for $300 million for loans and $50 million in revolving credit. Companies such as this also lease spaces, so they have operating leases, which is another important factor. We find that they had stock repurchase programs allows the repurchase of stock from a company in this case. The company had one active during this time, but it's nothing too interesting. Stock-based compensation is common these days, so it is important to check it out. They had multiple plans, including market awards, but we will not be talking about them as these details are too complicated. Stock-based compensation expenses for the 3 months ended totaled for about... Okay, last table to check out is net income. This gets a bit complex, but to sum it up quickly, net income per share was about 14 cents, but it's more realistically 9 cents. Last year this metric was negative, so a net positive 9 cents this year is good. Switching gears a bit, let's look at the legal stuff. From time to time, the company is subject to various legal proceedings and claims. Some of them are Norway matter, Israeli class action, and UK group action. At this time, there is nothing to worry about, as nothing is material. A bunch of people over there had trading arrangements. Some of the officers terminated and adopted plans and whatnot if you're into that type of stuff. This is just to test ED medication. Now, taking a broader view, Grindr appears to be navigating the complex landscape pretty well. Revenue growth is strong, turning last year's losses into a decent profit. However, the high spending on repurchasing shares is something to keep an eye on. Could they find a better place for that capital? The legal challenges are always present, so investors should monitor how those unfold. But based on these numbers, Grindr seems to be on a solid path forward. Alright, that's our breakdown of Grindr's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate filings. Don't forget to check out the Discord in the description for more discussion. Thanks for watching. See you next time.